Enlightened investors, I have some exciting news for those looking to dive into the world of passive real estate investing. Many have asked how I got my start in commercial real estate investing. Well, it all began with an event close to my heart. Multifamily Live is back, and this time it's online. This event holds a special place for me because it's where I got my start in commercial real estate investing. Imagine a virtual gathering where you can gain invaluable insights into how cash flow ready apartment buildings are the key to your passive income journey. Take the mystery out of passive real estate investing and step into the active side of the equation to gain a comprehensive understanding so you can invest passively with confidence. Whether you're a newbie or a seasoned investor, Multifamily Live is designed to cover everything from acquisition to asset management. You can be confident that you'll leave this event with a comprehensive understanding of commercial investing. Mark your calendars for May 9th to May 11th. Trust me, this is an event you won't want to miss. Ready to enhance those passive streams of income? Get your ticket now, and together, let's take the next step to enhance our financial well-being, to live abundantly and flourish in all areas of life. I'll see you in Multifamily Live. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen. And I'm so glad that you have decided to join us again today. And I know that you are going to be excited to be with us as usual. But today we have an unusual guest with us who has been on our show before. And I always like to have talented people return. So Ryan Smith is a principal at Elevation Capital Group with more than 15 years of extensive business experience. He has acquired properties worth more than $475 million, and he holds interest in over $175 million in assets across more than 30 states. Ryan graduated from the University of Tampa with a Bachelor's of Science in Computer Science and ultimately chose to pursue entrepreneurship. He was also a highly recruited athlete in baseball and basketball and was drafted as a senior in high school by the Baltimore Orioles and again in college by the Anaheim Angels. So welcome back to the show, Ryan, and we're delighted to have you with us. So take us into the show and share an experience that may have been pivotal to who you are today.
It's a good question. So many. I feel like, by God's good grace, and I've been able to stand on the back of giants, and that's led me to be here. So many specific stories, but I think, fundamentally, a lot of it is just built on the concept of work being a redeeming practice, a good practice. And so as a young person, I guess I'll pick one. My dad was not wealthy, didn't come from money, and actually dirt floor poor at one point of his life. He grew up, my grandfather, his dad was a preacher and planted Nazarene churches. And in those days, that wasn't a lucrative profession, maybe as it is in some respects today, but back then it was not. So anyway, my dad grew up very poor, and so when I was born, he was trying to make something for himself and trying to build, and had he was a roofer at one point, and so he learned that the person on the roof wasn't the one who made the money; it was the person who owned the roof. And so my dad, to a degree, decided to get off the roof and start buying roofs for himself, which was kind of a cool lesson learned. And so, but yet, as he started his own business when I was incredibly young, like call it, 1 years old, he still would buy houses and re-roof them himself. Mm-hmm. And so there's a photo of me in a crib on a roof that my dad was re-roofing. So, to kind of, that tells you a lot about him in a lot of ways. So anyway, I wouldn't say that's a memory because I can't claim it as as something I remember. I might have been two or three, but he wanted me on the roof with him while he was re-roofing a house to show me kind of the way it's done.
Wow.
Yeah.
Well, I know
Yeah.
safety standards have changed considerably since that time, but
True.
uh,
And knowing my dad, it wouldn't have changed the outcome.
wow. Well, I hope you hold on to that picture. That has got to be something to see that.
Yeah.
Well, Ryan, you have done a whole lot in the world of business, not just in the world in business and finance, not just in real estate. So just kind of fill us in on what's been going on with you for the last couple of years, the good, the bad, and the ugly.
Yeah, we've been busy. We have been acquisitive. We've acquired a lot of property. We continue to operate, our properties. We continue to develop and grow our management platform and continue to find, new talent and bring it in, bring people in, and try to continue to make a culture that from top to bottom is focused, integrated, united, cohesive, and focused on where we want it to be. So yeah, we've been busy in a lot of different areas. It's been good.
Have you been focusing on a particular geographic area? Have you been focusing on a particular sector or really where have you been and why?
Yeah, so our focus is purely mobile home parks and self-storage facilities. And in mobile home parks, just for, I guess the benefit of your listeners, if they're less familiar with that space, it is not RV parks. That is a different asset class. So we don't dabble in the RV park space, although that has been trendy lately. So anyway, mobile home parks, also known as manufactured housing communities, in sometimes called trailer parks. So that's a focus of ours with self-storage. And then in terms of geography, both asset classes have, different geographic footprints that we would be interested in. As a very broad brush, if somebody asks me in passing, I'll say we're national and that we pretty much will look at anything anywhere. But as a general statement, mobile home parks, we do not want to be in, heavily regulated areas where, it's just restrictive and doesn't allow us to do what we think is best for the residents. And so generally that's California, the Pacific Northwest. We have concerns about New England states, not just regulatory, but also population decline. And there's all kinds of business decline. Pennsylvania has some onerous regulation they just passed. Colorado has some challenging regulation. New York is a little dicey. But other than that, we're pretty open on the mobile home park side. And then storage, we're pretty interested, everywhere. Just has to be, a major metropolitan area with good, high barriers to entry on the property so that it would be very difficult for new competitors to come compete with us.
Mhm. Well, lots of questions arise from that. You just mentioned self-storage and the high barrier. Self-storage is often thought of as a low barrier entry. So, and that is, of course, one of the risks with self-storage. But you're looking at areas that have high barriers. What are those high barriers that make it less risky for you?
Yeah, so a lot of the times it's, like we own a storage facility we bought a couple of years ago. I want to say it was summer of 21 off the top of my head. And it's out in Alexandria, Virginia. So, I mean, you can stand on the roof and see the Washington Monument. We're about a mile and a half down the road from the Pentagon. So very well located, major thoroughfare. If you were to pull up a Google map of the area, you're not going to find a lot of green space. So there's just really not a lot of availability. So, and then it's not overly feasible to buy a building, and pay what you might for the building and then change its use and rebuild and do all of that. So
Mhm.
so they're just natural barriers. And then when you add on the regulatory framework of Alexandria, it's a very difficult city to get things done in. Anybody who's ever dealt with Alexandria, it's pretty challenging.
Mhm.
And I'll give you an example. Just to film, we usually film our assets, pre and post closing. just to film, get a drone video of the asset, we had to hire a third-party company where normally we would fly our own drone. And then we had to, off of memory, I think we had to get two like former CIA agents, or they had to be like they have to have some security clearance. We had to have two of them to stand and flank the drone operator while they filmed. And we had to agree to all of this in order to get a permit from the city in order to film our asset. And then we had to enter into an agreement where any of the footage obtained had to be then given to the city for their use for what, I mean, it was just all of this just to get a video of an asset. If it was that cumbersome just to film the asset, imagine trying to build one from scratch. So those are the kind of barriers we want. Is we want to buy in locations where we're buying an existing asset with high barriers, and hopefully the high barriers stay and prevent new competition in the future. But I agree with your point that storage as a general statement, especially in areas where there's lots of land and land is cheap, like Arizona and often Texas and certain, those kind of areas, we're pretty picky on markets like that because we do not want to build or buy where you can do the same easily.
Well, in and using this as one of your criteria, the high entry point, I would also think that would certainly increase the purchase price of that, which would make it more difficult to make it a feasible operation for returns on investment. So how do you balance the high entry with the higher purchase prices there?
Yeah, it's really risk reward. It comes down to what an investor wants and what you I think are finding in this market, because the market has shifted over the last year, against prior years where, risk really wasn't it wasn't a high consideration for a lot of investors because they thought everything was up and to the right. Risk is a lot more important, or a lot more on the minds of investors, I think, today than it was 2 years ago. So you had a lot of groups say, yeah, probably not a big deal. I'll take the cheaper rural property, as opposed to paying a premium for location. But to your point, there's a reason good location with high barriers have a premium. It's worth something. And to the extent that we can get that value for a discount, although we're still paying a premium, that's intriguing to us. And I think in the long run, you do not tend to regret, really well located, high quality, high barrier assets in the long run, but you will tend to regret, low quality rural, low barrier assets. So for us, I mean, obviously the numbers have to pencil, but to the extent that they do, all things, being equal, our preferences, we're okay with a lower return day one with a higher probability of a good outcome year 10, as opposed to a higher return day one and a lower probability of an outcome year 10.
Yeah. Well, I would think with the high entry barrier there, that you can much more reliably predict. With the low entry barriers, you could have a wonderful projection and everything could be fine until somebody comes in and builds a storage facility right next door to you, which would change your whole predictions there. So
yeah, and I had a broker, this was probably a year ago, sent me to look at a deal kind of 30 minutes away from another asset we owned. And so I took a look at it. It was in Florida, storage. And so I looked at it, and the asset itself was great. It was very well done, good layout, good unit mix, good size, all of that was great. But as you approach the asset down this busy road, all you see is these for sale signs of big parcels of land. And it was like for sale, for sale. And you can tell they were probably advertised for sale somewhere around the year of my birth, or maybe the time I was in a cradle on a roof in Central Florida. But the point is, they've been advertised for sale for decades and haven't found a buyer. So my comment to the broker was, I said, I think it's not for us for these reasons, but ultimately, I think you do okay as long as you don't do great.
mm-hmm.
And he started laughing as he thought about it. And it's true. Like you'll do okay if you don't do great, because if you do great, somebody's going to just squat on you. They're going to come build next to you, and then you'll do okay. So you kind of want to satisfactorily underperform on that asset to a degree. You kind of want to stay under the radar and look miserable, but maybe do a little bit better. And that's not really where we want to play. We want, as much as we can, kind of an unobstructed path to excellent over time and not have to worry about people squatting. And for what it's worth, I don't want to make this too absolute. Even if we do all of the work, and even if we get a relatively high barrier asset, you still will likely have competition enter the market. Let's say a 5 mile radius over time. That's still going to happen. But one new entrant in a 5 mile radius is very different than 3 new entrants in a 1 mile radius. So we're trying to protect as much as we can against the latter. The former will naturally happen.
Mm-hmm. Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, I would also think that with the high entry barrier there, you probably have an asset that even if someone did come in and able to compete with that at, a 5 mile distance or what have you, and they put in a brand new facility and what have you, I think that you would probably be in a position that you could do some renovation to continue to attract a respectable clientele. Whereas if anyone can just come in at that low barrier price, they can outbuild you and still underprice you if they have the capital reserves and what have you. So, yeah.
Yep.
I had never really thought of self-storage from that perspective. Well, I mean, I have thought of the fact of the risk that, anybody could come in there, but I hadn't thought of really looking for the high barrier properties there.
Yeah. And there's a couple of other examples, like just to throw one out really quickly. There's actually 2 properties we built from the ground up in Denver. And those 2 properties were the last approved before a moratorium went in place, disallowing the construction of new storage facilities. Mm-hmm. So, in that case, there's another barrier to entry, right? We can build, but you can't. And that's what we want as much as we can.
Did you know that going in, or were you just fortunate you knew that going
in? We did. And for what it's worth, there's gamble, they as the moratorium can, they can, as quickly as they put it up, they can take it down, conceivably. So, but we thought it would be sustainable, and so far it has.
Yeah. Well, good. Well, in terms of market, what is the market like in terms of overall self-storage? Is it a really hot market? Or, I mean, it was a couple of years ago. Has that sustained and it's still very competitive? What's going on there?
So it depends on one aspect. So on the kind of the asset ownership side, the buying and selling of storage assets, it's still pretty competitive. There's a lot of dry powder, a lot of capital, looking for a home today. And so storage, remains on a lot of people's radar. And so, there's a lot of trading of assets, buying and selling. It's pretty active, pretty robust, which is great. On the operation side, or kind of the demand side, as it pertains to, customers, it's soft right now. So the market, to your point a minute ago, post COVID to a degree, call it 2021, 2022, when everybody was, interest rates were low, everybody was work from home, they were buying second homes somewhere else, and better look. So there was a lot of transactional volume. There's a lot of friction, people moving. That's really stimulative to storage. And, you also had through COVID, you had people, concerned about health matters. So they were working from home a lot more, they were homeschooling their kids. So all the extra rooms in the house were being utilized. So the storage room now had to go to a storage facility. So anyway, you had a lot of demand, and rates, occupancy was crazy. Rental increases, top line increase, and revenue increase was great. And so we started seeing a slowdown in that September of last year. And it seems to, from what I can tell, and a lot of that kind of third-party data seems to indicate that the bottom has kind of hit. We're watching, maybe it is, maybe it isn't, but we expect 2025 for things to really get moving again on the demand side, if not sooner. But we think at the latest 2025. So right now it's soft, still a good business, but just soft, and that's normal.
We are speaking today with Ryan Smith, and he is with Elevation Capital Group, and you can find them at elevationcapitalgroup.com. So, Ryan, let's change our conversation here to mobile home parks and what's been going on in that arena for the last couple of years.
Really nothing. I mean, it's a in an exciting way, it's a boring asset class. Depending on, a lot of people today would, I think, generally prefer boring as a strategy as opposed to exciting, because it's kind of still a little bit of a risk off kind of attitude. But anyway, mobile home parks are great. Mobile home parks, demand continues to be sky high, relative to supply. There's a couple of publications, national publications, that indicate that the current supply is about 1/4 of current demand. And I don't, to the extent that that's true, I don't see, demand falling off a cliff anytime soon, meaning we're meeting that demand. I don't see affordability getting better anytime soon, unfortunately. And then mobile home parks are really uniquely positioned to address the issue of affordability. And I'll just briefly describe why, because I think it's maybe helpful to think about for your listeners. But typically when when you hear, okay, a house is unaffordable or unaffordable housing, what a lot of times the market does is they try to find more innovative ways to build the structure. And that's where people think, containers, or blockable or modular, or 3D printed, right? Outfit out of Texas, 3D printing homes with concrete. So there's all these innovative new technologies that go into the structure to bring down costs of the structure. But it's actually interesting that the structure is not the part of the home that makes it unaffordable. The part that is unaffordable is the land.
Mhm.
So, the land cost is what makes most homes unaffordable. And so you can be as innovative as you want with the structure. You're not addressing the reason it's unaffordable. Mobile home parks do that, in that you own the structure, but you don't own the land.
Mhm.
And so it actually removes the piece. You can own your own home. You can own the mobile home. And in our model that we prefer is to own parks where every resident is a homeowner. And so it's a fun business in that way, because to the extent that we have a park that we buy, where, let's say, you buy a park and the residents are currently renting the homes, we get to come in and really work with them to help them become homeowners, which is rewarding. But at the end of the day, we want all of our residents to be homeowners. And so they own the structure, which is the affordable part. And then they're not required to buy the land, which is the unaffordable part, which is why it's affordable.
Mhm.
And so anyway, that business is great. There's a lot of demand. There's really practically no new supply of mobile home parks. They're really difficult to build, to develop. And so anyway, we think it's a great business.
Yeah, that's what I hear from everyone who is in it. And I mean, it's interesting to me that the demographics are so positive towards that. Like you said, that it's meeting a quarter of the demand that's out there, and the trends indicate that that is only going to, continue to get worse from the buyer or from the homeowner's perspective, but good for the mobile home park owner. And you talked about the high entry to barrier. Well, for whatever reason it is, even these urban areas who are dying for affordable housing, they just can't provide it at the rate that it's being demanded today. They still are not opening up their code, uh, their coding requirements and building requirements to allow for new construction of mobile home parks. So we're essentially left with what's there. So that's an extraordinarily high entry to barrier in that regard there. And yet, from my understanding, mobile home parks are still holding pretty impressive cap rates. Is this the case?
Yeah, and it kind of goes to what we were talking about earlier in terms of, there's a premium for predictability of cash flow. When I got into the business, you could buy a really low end rural mobile home park for in the 20s, cap rate in the 20s.
Wow.
And I mean that literally. I didn't misspeak or slip
Yeah.
up or, it was unbelievable. But over time, more and more people have found the space, and have started deploying capital here. Now there's, significant institutions. You got BlackRock, you got Carlyle Group, TPG, you've got, big companies with big dollars that are building portfolios and allocations, over time, and some of them sell and trade in and out. But ultimately, there's a lot of institutional capital in the space. So cap rates have compressed. Today, as an average, the cap rate across all qualities, all locations, probably in the 6 range. But the other benefit of mobile home parks that you really don't get in storage is you can get agency financing, Freddie and Fannie, and that helps keep, cap rates lower because there's just a lot of compelling capital that, could be obtained for the purpose of purchasing these assets. So yeah, anyway, yeah, cap rates have certainly come down over the last 20 years significantly. They've gone up a little bit over the last year or so, but not meaningfully, maybe 10, 15, 20%. And so in some cases more, depending on the quality and the location. But I think what I have been able to tell, and this is anecdotal, but it seems to me that the lower quality assets have had more of an increase as a percentage of its cap rate as compared to the higher quality, lower cap rate assets, because they really all got compressed. You had some really low quality assets, maybe a year ago or prior, selling for, 5 to 6 cap, that they were really, 8 to 10, maybe, but the market would bear it at the time. So there's a lot of money flying. Those assets are now, probably back in the 8 to 10 range, which is a pretty big move, relative to what they're trading at, but the lower cap rate, higher quality assets haven't seen that much decompression.
Yeah. What's one of your greatest setbacks in the last couple of years?
I would say partners are always tricky, not because they're just it's not even a setback. I would just say, struggle is always, I would say partnerships in general over time are a struggle. So just working through those, as especially amongst, different ages of partners, different seasons of life. And we've been pretty successful at working through those, but those are never fun conversations. And we've had a couple of those.
Yeah. Well, enlightened investors, we have been visiting with Ryan Smith of Elevation Capital Group, and that's elevationcapitalgroup.com. You can find all of his contact information in our show notes. Enlightened investors, thank you so much for being with us again today, and I hope you've gotten as much out of the show as I have. And if you've enjoyed the show, please remember to like, share, and subscribe, and take a moment to go to your favorite podcast app and leave us a rating and a review. Until next time, live abundantly in all areas of your life, and we'll see you in the next episode. Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures great and small flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.